The clock reads 9:27 a.m. on September 15th, 2008. Inside a Manhattan trading floor, there is no shouting, no chaos, just silence. On hundreds of screens, numbers flicker, but one number matters more than all the others. Lehman Brothers. 0. A firm that survived the Civil War, 2 World Wars, and the Great Depression has just collapsed in a single weekend. Across the room, a portfolio manager doesn't panic. He picks up the phone and says, buy more gold, increase treasury exposure, move into farmland funds. This wasn't luck. It was preparation. While the public panics, a small group of investors moves with precision, almost like they've seen it all before. Why do the wealthiest investors consistently shift into the same 5 types of assets, just before everything falls apart? What do they see that others miss? To understand this, we must look at the promise of modern finance. In the early 20th century, markets were chaotic and data was scarce. Then came a revolution. In 1952, Harry Markowitz proposed that by diversifying investments, you could reduce risk without sacrificing returns. By the 1970s, risk became quantifiable. Financial markets transformed and institutions began constructing portfolios based on mathematical optimization. Risk was engineered. But here lies the first paradox. The more precisely risk is modeled, the more invisible it becomes as systems grow more complex and interconnected. A new class of investor emerges, allocators who don't chase trends. They anticipate cycles and realize every boom contains the seeds of its own collapse. Imagine the economy as a machine. First, credit. Second, asset prices. Third, confidence. When credit expands, people borrow more and buy assets. As demand increases, prices rise, creating confidence. But if prices fall, the chain reverses. Credit contracts and forced selling begins. This is the collapse. Sophisticated investors watch credit conditions, not just prices. When the fuel starts running out, they reallocate capital quietly and strategically. The first asset they move into is gold. It has survived for thousands of years because it is not dependent on the financial system. The second asset is government bonds, specifically high-quality sovereign debt. In times of crisis, capital seeks the highest certainty, not the highest return. The third category is cash. During a crash, cash becomes optionality. It allows investors to act when others are forced to sell. It's dry powder. Fourth, defensive equities like utilities and healthcare. People still need electricity and medicine even when the broader economy contracts. Finally, real assets, farmland and infrastructure. These assets are anchored in physical reality and produce tangible value through food and energy. Collectively, these reveal a strategy optimized for resilience. The investors who build the most wealth are often the ones most focused on not losing it. Timing a market is a psychological challenge. Shifting too early means underperforming during the final explosive stages of a bull market. This is how bubbles sustain themselves, through incentives and the pressure to believe that this time is different. Fear and greed are core drivers. The ticking time bomb isn't a single event, but a buildup of interconnected vulnerabilities, leverage, complexity, overconfidence. Together, they are explosive. The moment of collapse never feels dramatic at first. There is no explosion, no single event that announces the end. Instead, it begins with something subtle, a slowdown. In early 2007, U.S. housing prices stopped rising, not crashing, not collapsing, just stopping. For most people, this means nothing. But inside the financial system, this tiny shift triggers a chain reaction. Trillions of dollars were built on one assumption, that housing prices would continue to rise, or at the very least, never fall nationwide. When that assumption breaks, everything else follows. Let's walk through the mechanism step by step. Imagine a homeowner who takes out a mortgage. That mortgage is not held by the bank. Instead, it is bundled with thousands of others into a financial product called a mortgage-backed security. These securities are then sliced into layers. Investors around the world buy these layers, believing they understand the risk. But the models rely on historical data. And that data assumes that housing markets are not highly correlated. In simple terms, if Florida collapses, California will be fine. But reality doesn't behave that way. When credit conditions tighten, all regions begin to fall together. Correlation spikes, diversification fails. Now, leverage amplifies the problem. Institutions are borrowing, sometimes 40 times their capital. A small decline wipes out their entire equity. When losses begin, lenders demand more collateral. This triggers forced selling. And forced selling drives prices down further. This is the feedback loop. Certain investors are not reacting. They are positioned. Gold begins to rise, not because it is productive, but because trust is collapsing. Government bonds surge as capital flees risk. Cash becomes king. Defensive equities fall, but far less than the broader market. These assets are not dependent on the same assumptions that are now failing. But here's the critical detail. These investors moved during the expansion, when markets were still rising, when optimism was still high, because by the time a crash becomes obvious, it is already too late. Liquidity dries up, Prices gap down, opportunities disappear. This is the catalyst moment, the realization that the system is no longer stable. Banks stop trusting each other. Interbank lending freezes, companies lose access to funding, payrolls are missed, layoffs begin. What started as a financial problem becomes an economic one, and then a social one, not numbers on a screen, but livelihoods, time, trust. Now step back. This isn't just history, this is a blueprint. The same mechanisms still exist today, but at a larger scale. Consider modern markets. ETFs concentrate capital. Private equity uses debt-heavy structures. Crypto introduces new forms of leverage. Government debt levels reach historic highs. Each of these systems functions during stability, but under stress, they can amplify volatility. So, what should you actually watch? Not headlines, but structural signals. First, credit expansion. Is debt growing faster than income? Second, asset valuations. Are prices rising faster than fundamentals? Third, market concentration. Is risk being centralized? Fourth, liquidity conditions. And finally, narrative intensity. Are people justifying extreme valuations with new theories? This time is different is not analysis. It is a warning sign. Think of the market as a system under pressure. Beyond a threshold, small changes create disproportionate effects. This is called nonlinear behavior. Crashes feel sudden, though they are built over years. Your goal is to recognize when the system is becoming fragile and adjust accordingly. Wealthy investors are preparing for a range of outcomes. They reduce exposure to systemic risk and increase exposure to resilience, maintaining the ability to act, because destruction leads to opportunity. In 2008, the manager who moved into gold and bonds wasn't reacting to a collapse. He was responding to conditions building for years. Financial crises are not random. They are the logical conclusion of systems pushed beyond their limits. The best assets have independence. Gold doesn't depend on earnings. Bonds depend on stability. Cash on liquidity. Defensive stocks on necessity. Real assets on physical demand. Every crash begins the same way, with a belief that something fundamental cannot break, until it does. Understanding this is about clarity. Wealth is not built by avoiding risk. It is built by understanding it, by recognizing when the system itself becomes the greatest risk.